Let's talk some more about the Fed and the macro picture. Joining us this morning is Apollo Global Management's Torsten Slok. We wish you were on set, but it's good to see you. Happy Monday.
Happy Monday.
We got a bunch of things that I want to cover. I want to get to your AI adoption chart. I want to get to your market extreme concentration stuff. But on this week's inflation data, do you think it's going to muddy the picture for what the Fed can do next week?
I think that is a very good expression, Carl, because last week we found out, of course, on Friday that the labor market is weakening. When the labor market is weakening, the Fed is supposed to cut rates. The problem is that for Thursday's CPI number, the consensus is now expecting inflation to go up from 2.7 to 2.9. And that is exactly muddying the picture, because when inflation goes up, the Fed should be hiking. So that's why going into next week, the numbers that we get on Thursday will be very, very important, because if we have the number on Thursday that is better than expected, meaning lower than expected, it will confirm that it's okay for the Fed to begin to cut rates. But in the worst case, if inflation surprises to the upside, it will really make it tricky, and we could begin to have a discussion about dissents next week, namely, how does the Fed do policy making when one side of the dual mandate says it should be cutting and the other side says it should be hiking?
B of A today says there's not much precedent for a cutting cycle in which the Fed doesn't cut at every meeting. They do see 25 here, but they think they'll skip. They won't cut in October. Does that make sense to you?
Well, I think that the Fed members and the FOMC members have been focusing on that maybe it is less relevant to look at current inflation, but instead focus at inflation expectations. So in that sense, with the labor market weakening, not in a worrying way, but in a somewhat negative way here, where we will probably not have a recession, but we are having a slowdown, I think from a risk management perspective, their argument will be at the meeting next week that we will say, well, on the one hand, yes, the labor market is weakening, but inflation expectations are stable, and at the same time, inflation, yes, it may be higher, but ultimately, inflation will be coming down. So I think that they will begin to talk more about inflation expectations and begin to put less weight on current inflation and instead on future inflation.
One thing that I'm going to be watching, Torsten, in the report is the supercore inflation. Because we know that's what the Fed has been watching. It's services of inflation ex housing. Because if we see inflation in goods, they're expecting that. I mean, that has been happening a little bit with tariffs, and that is, I think, likely to be considered temporary. It would be a bigger worrisome symbol if it's spreading out into the broader economy, and that's something the Fed would have to do about it.
Absolutely. Austin Goldsby has talked a lot about this issue, namely, so goods make up a third of the CPI basket, services makes up 2/3. And for a while now, we have been used to that because of tariffs, goods inflation is going up, but it only has a weight of a third, so it's been somewhat comforting that, well, it's going up, but it doesn't have a very significant weight in the index overall. But the problem is ISM services prices paid has really started to go up in the last 5-6 months. So that's a leading indicator for what's happening to service inflation. And exactly as you're saying, Sarah, if this starts to spill over to not only the goods sector, where tariffs, of course, are hitting most immediately, then also begins to spill over, especially to the wage parts and, broadly speaking, the service sector as a sector overall. That could put upward pressure on the service component of CPI. So that's why in Thursday's data, the services component will get a lot of attention, because in the last few months, that's been more stable and people are now worrying that that might begin to move higher.
We had a nice debate about your AI adoption chart over the weekend and whether or not these sort of census surveys, high-frequency census surveys, asking companies, or have you used AI tools in the last couple of weeks, you trust this number?
Well, the census asks more than 1 million companies whether they're using AI. So AI here is agents, it's voice recognition, it's various tools that we normally would categorize under AI implementation for corporates. And what's interesting is in the last 6-8 weeks, we've started to see a slowdown in AI adoption rates, meaning in the usage of AI, especially for companies with more than 200 employees. So that's not necessarily a new trend where we are going down more permanently, but it is quite noteworthy in the broader debate around AI overvaluations, about AI market concentration, not only in market caps, also in capex. AI has a big weight, in earnings AI has a big weight, and in returns for the S&P 500 AI has a big weight. So we're just watching every indicator, turning every stone in the garden, and when we looked under this stone here and saw that larger companies are beginning to slow down, it does make us a little bit worried that we should be monitoring very carefully exactly this discussion we're all having, namely exactly how is AI being implemented in different companies, especially small versus large companies.